Chapter 9, Partnership Formation and Operation. So this is just a general graphic showing what it looks like when you have two partners, partner A and partner B, contributing. Partner B is contributing cash, partner A is contributing property, and in exchange for what they contribute, they're both receiving a partnership interest. So this is basically at the formation, the outset of the partnership arrangement. And we talked about this a little bit last semester, and I believe a little bit earlier this semester as well. But basically, when you form a partnership, it doesn't necessarily have to be a formal agreement that exists. It basically happens whenever two or more people get together for some type of economic enterprise, and is just the default status if you have not organized as a corporation or some other, S Corp or some other hybrid type of organization, then you have formed a partnership. Now, hopefully you're doing that deliberately, and anyone who does it deliberately is usually going to draft some type of partnership agreement that sets out a lot of the logistical nuts and bolts of how the partnership's going to go. For instance, things like distribution of income and losses, whether that's going, the default rule is just goes by, the percentage interest that you own in the partnership. So for this graphic, it would be a 50-50 split. As income comes in, you get 50% of it. As losses occur, you incur 50% of that. But it could really be, whatever the partnership agreement sets out and states. So this should be a little bit of a review, but general versus limited partnerships. A general partnership is basically the default, and this, as the bullet points show there, any of the partners can make binding decisions for the entire entity. However, also with that, each partner has unlimited liability to include personal liability for partnership debts, and also can incur legal liability, not criminal of course, but civil liability for legal actions because of the actions of one of the other partners. Limited partnership has generally general partners, and they are still treated just like any general partner would be in a general partnership, but then also includes at least one limited partner who has limited liability and basically can only be liable for whatever their investment was in the partnership. What this usually works out to be is you have general partners who are kind of running the partnership, and then you have limited partners who may just be contributing capital and kind of viewing it as an investment where they get a certain percentage of the income that comes in. So these are just investors that generally have nothing to do with the day-to-day operations of the partnership. Then there's, of those limited partnerships or partnerships where there's limited liability, you have LLLPs, which is a limited liability, limited partnership. Same features of a limited partnership where you basically have some partners who are taking part in the day-to-day operations, and then some partners that are kind of just there for investment purposes. And in an LLLP, pretty much everyone in the partnership, not just the limited partners, enjoys limited liability where essentially they're protected in most cases from their personal assets being attacked because of the actions of one of the other members of the partnership. Then you have LLCs, which are kind of considered hybrid entities, treated generally as a partnership for tax purposes. However, they can also be treated as a corporation. That's what that third bullet point in that category is talking about right here. If you want it to be treated as a corporation, and more often what happens is LLCs will choose to be taxed as S corporations. There are some tax benefits in certain cases of doing that, so you have the option of checking the box and being taxed as an S Corp, but enjoying partnership status basically for other purposes, except that you also get the limited liability. So you have some of the good things about a partnership and some of the good things about a corporation, and that's why it's called a hybrid entity. LLPs operate similarly to LLCs. They're also considered hybrid entities in that you get the limited liability of a corporation, but a lot of the benefits of a partnership. And I think I may have mentioned this before, but LLPs, and also for that matter LLLPs, you generally see in the service type, the personal service industry. So you have, law firms, accounting firms are the two big types where you see that most often. Other than that, you pretty much would normally see someone who's interested in a hybrid organization will usually go with the LLCs. Okay, so as far as partnership profits and losses go, a partnership is not taxed at the entity level. However, income is allocated at the entity level. You have some tax deductions that occur at the entity level, and then these are, once those the deductions are taken out, there is an informational form that's filled out at the partnership level, but then the actual payment of taxes doesn't occur until the income is distributed to the partners based on either the partnership agreement or some default rules, which is normally just percentage ownership in the company or basis percentage. Calculating a partner's basis, this is a handy slide to have for reference purposes. You're going to start with whatever contribution the partner made to get an ownership interest in the partnership. So obviously any cash or fair market value of any property contributed, plus any share of outstanding partnership debt that is being incurred. So basically, if you're taking a 20% interest in a partnership, then whatever the partnership liabilities are at the time you take ownership, 20% of those will be added to whatever you contributed to make your initial partnership basis. And then you're going to add or subtract whatever the partner's share of the operations are. So you will add anytime income is made by the partnership and anytime debt is incurred, and you will subtract from your individual partner basis anytime losses are incurred or debt is paid off. And what you have left is the ending partner's basis. So a quick example of that: Tom buys 20% interest in XY partnership for $8,000 on January 1. Materially participates, and that kind of just tells you that this is a general partner. XY partnership has $2,000 in liabilities. The following year, XY takes on $4,000 in additional debt and incurs a $10,000 loss. So how do you calculate that? Well, you start with Tom's contribution, $8,000. You're going to add Tom's share of the debt whenever that initial ownership 20% takes place. So you have $2,000 and $4,000 as the debt. You're going to take 20% of that, which gives you $1,200. And then you're going to take 20% of the operating loss of $2,000 and subtract that out. And you're left with a basis of $7,200. Non-liquidating distributions are non-taxable to the extent of the basis. So when money is distributed out from the partnership, that is a non-taxable event up until the basis is lowered down to zero. So if you back up real quick here to this slide, I guess it'd be easier just to look at, since we don't really talk about distributions in that slide, just to think about it. Let's see, yeah, we'll go back to this slide. So this is when you're actually receiving income from or you're receiving a distribution from the partnership. You're not taxed on that distribution based all the way up until your basis is eliminated. And so this would lower your basis as you receive these distributions. And then everything above and beyond the amount that caused your basis to be lowered to 0 is considered a taxable gain. So taking the numbers from the previous example, assuming XY distributes to Tom $9,000, then Tom has a gain of $1,800 because he received a $9,000 distribution and his basis was $7,200 before that distribution. So after that distribution, his basis is now 0, and he has a taxable gain of $1,800. The general rule when a partnership is formed is that there's no recognition of gain or loss based on property in exchange for partnership interest. This is similar to a similar rule we talked about with corporations. And the idea behind that basically is when you contribute cash or property to a partnership in exchange for ownership interest, you're basically giving that cash or ownership to yourself, because you are now an owner of the partnership, and so you are taking money that or property that was yours and giving it to yourself in another way. So that doesn't really make sense to recognize a gain or loss on that contribution. However, there are some exceptions to that general rule of non-recognition. You will recognize a gain or a loss if the overall partnership that you're contributing to is considered to be an investment company. Okay. Also, if there is some prearranged contribution distribution scheme. So this is basically if you have already set out, okay, I'm going to contribute this and then I'm going to receive this as a distribution, to where you're not really assuming an ownership in the partnership. This is basically saying that you're not allowed to use the purchase of a partnership interest as just a tax shield for trying to contribute property to an entity. Third example there is when the partnership assumes a partner's share of liabilities, and that share that is assumed, and I think we'll look at an example of this in the next slide or one after that, but the share of liabilities that is assumed by the partnership exceeds the partner's basis in whatever in the partnership. Okay, so if that occurs, then the extent to which that is exceeded will have to recognize, the partner will have to recognize a gain there. So here's an example of that. Mary contributes land in exchange for 20% partnership interest. Partnership has $4,000 in liabilities. Fair market value of the land is $60,000. Her basis is $30,000. And Mary's liability on the land, which is assumed by the partnership, is $50,000. So how does that play out? So the basis on the land when it's carried over to the partnership is $30,000 plus Mary's share of partnership liabilities. So you're going to add $800 to that, minus the debt assumed by other partners. So you're going to take Mary's overall debt or liability on that property of $50,000, and since 80% of that is being assumed by the partnership, Mary's still keeping 20% of that debt because she now owns 20% of the partnership. So you're going to take 80% multiplied by that $50,000 and subtract out the answer of $40,000, and that gives you $30,800 minus $40,000, and which would actually give Mary a negative basis in her partnership interest. However, that can't be a negative number. So the difference, the amount that would be negative, so in this case that would be negative $9,200, that $9,200 Mary has to recognize as a gain. So she has a $0 basis in the partnership and recognizes a $9,200 gain based on that contribution. So the character of the gain is important. So this is, whether it's an ordinary income, whether it's capital gain, that's what we're talking about when we say character of the gain. So the partnership assumption, when a partnership assumes a partner's liability, that's considered the equivalent of a cash distribution. So we would treat it as such. If partner must recognize gain, so that's in the case where that cash distribution that we see right here exceeds the partner's basis, the character would be determined by partnership rules. And basically that boils down to any gain recognized because of the distribution right here being greater than the partner's basis, generally considered a capital gain. Okay, that's the general rule. Holding period for a partnership interest. A partner's holding period of any property that they are contributing to a partnership, so whenever their holding period began and then they contribute that property to a partnership, the partnership assumes the holding period of the partner. So it just tacks on to whatever the partnership's holding period ends up being for that property. But it must be a capital asset or Section 1231 property, which just means some type of depreciable property. And you see an example there. Sue contributes a building she's owned for 5 years to the partnership in exchange for a 20% interest. And because of that 5-year holding period, day one of the ownership that the partnership has on that asset, they have a 5-year holding period. Okay. So under Section 723, that's the code section that tells you the general rule that the partnership assumes the carryover basis. If the gain is recognized by a partner because partnership is an investment company, partnership increases basis in the property. So the partnership being an investment company was one of those exceptions to the non-recognition rule. So if you meet that exception and you have to recognize gain because of what you're contributing to the partnership, then whatever the basis you had in that asset, that jumps up to the basis you had plus whatever gain you had to recognize. And any gain recognized by a partner because of assumption of partner liability. So again, this is when the asset, when the liability taken over by the rest of the partnership is greater than the partner's interest, basis interest in the partnership, that does not cause the basis in the property to increase. So you still recognize the gain there, but the basis in the property is not jumped up to whatever basis plus gain, like it is in that second bullet point. So again, the general rule for the character of the gain or loss is, and this is kind of similar to, or I guess it has a tie-in to that previous slide, because the holding period is going to determine long-term versus short-term. So a component of this rule is the long-term, short-term carryover characteristics would carry over to the partnership, but also the nature of the asset contributed will if that is going to determine whether it's a capital versus ordinary income gain, that will tack and carry over as well. So examples of that, or the best example would be if you contribute something that's inventory in your hands to the partnership, it's still considered ordinary income when it's sold by the partnership. So if you had sold inventory and contributed that cash to the partnership, then you would have had to recognize that as ordinary income, and then you would have contributed the cash. Well, you're not going to be able to circumvent that recognition of ordinary income just by contributing that to the partnership. That's the general rule. Exception: all gain or loss is treated as ordinary for any property that's contributed within 5 years of disposition. And that's really worded a little bit backwards. And that basically is if there's a gain or loss based on property that is disposed of within 5 years of contribution, that would be considered an ordinary gain or loss. So it would lose, basically, it would lose its capital nature if it's disposed of by the partnership within 5 years of contribution. If a partnership sells within 5 years contributed property with built-in loss, and so this is basically property that a loss would have been recognized on when it was contributed, but since no gain or loss was recognized based on the partner contributing this asset, that portion of it is considered a built-in loss. When the property is disposed of, then that portion that was built in is considered a capital loss. Okay. However, if the loss on that property is greater than the portion that was built in when the property was contributed, only the built-in portion is considered a capital loss. Anything above and beyond that amount depends on the character of the property in the hands of the partnership. So again, you just look at the general nature of that property. For instance, is that property inventory? If so, then everything above and beyond So up till now, we've just talked about a person's contribution to the partnership in exchange for an interest being either cash or property. However, there also arises the occasion where the partner in question or the person buying into the partnership wants to exchange some type of personal services that they would do. So, for instance, if I was joining a CPA firm or partnership, and I also happen to be a web developer, and I can redo the website or something like that, and I wanted to buy in based on the contribution of my web design services to the partnership in exchange for a partnership interest. So that would be me contributing my services in exchange for that interest. The general rule in that scenario is that I would then have to recognize regular income on those services. And the amount of that income would be as if whatever the fair market value of the interest in the partnership that I'm receiving, whatever that is, I would have to treat it as if I was performing web design services in exchange for that dollar amount. And the fair market value of the capital interest is determined by basically assuming that I now own that capital interest in the partnership. If that next second the partnership was liquidated, what would I receive? Okay. If I am only going to receive an interest in the profit. So for instance, I'm buying into the partnership, and what I'm basically doing is buying a 20% interest in the profits and or losses that the partnership incurs. Okay, so I don't really own any equity in the partnership. I just own an interest in the profits. If that's the case, then we would wait until some income is recognized by the partnership, and then that's when we would determine basically what I would then owe. So under that third bullet point, when I'm just getting a profits interest, this is kind of an ongoing thing where I would recognize income as if I'm performing these web design services for an installment of income every time income is generated. The partnership as an entity can use these payments for services as a deduction to overall partnership income in the year that the partner who's receiving this income recognizes the income. The partnership then allocates that expense as a deduction to the partners other than the service partner. So basically, obviously, the service partner, it doesn't make sense for that partner to be able to get a deduction for part of the income that that particular partner is having to recognize. So it's just everyone else in the partnership that gets to recognize part of that partnership interest income deduction. And basically, for tax purposes, we consider that when a partnership issues an interest in the partnership in exchange for services, the partnership has sold whatever the proportionate share of assets in the partnership is in exchange for the services. So we're basically treating that proportion of the assets as payment to this partner. So we're essentially treating that as a purchase and sale of those assets. Because of that, the partnership as an entity needs to recognize gain or loss on the percent of assets sold. And the bases of the partnership's assets must be increased or decreased by the gain or loss. So basically, whatever the gain or loss works out to be, you're going to either increase or decrease over the total. You're basically going to spread that increase or decrease proportionally over the total amount of assets based on that recognition of gain or loss.